In the last video, we saw how a chart of accounts was simply a listing of the various accounts that we would use in our book, um, categorized by assets, then liabilities, and then equities. Now we'll look at the general ledger. The general ledger is just essentially that same chart, categorized the same way, but this time with the balances that are in that account posted in a column beside the account name. So the question is, how do we go ahead and determine those balances? For that, we use another item called the general journal. And the general journal is probably the most important document for accurate record keeping that you're going to have. The general journal has several columns. It is a chronological listing of the transactions that go through your books. So the first column will be the date that the transaction was made, not the date of posting, but the date of the transaction. The next column will be a reference number of some sort. If you're writing a check, then it would be the check reference number. If you're making a bank deposit, then it would be a bank deposit number. If you're purchasing an item from a supplier, as here, it would be the supplier invoice number, and so on. The reason for the reference number is that you really want a source document in paper to back up every entry in the journal, with the exception of a few what we would call adjustment entries or internal transfers. Because if Revenue Canada comes calling, they're going to want to know how you can justify a particular expense and the recording of accurate income. The third column would be a description of what accounts are being affected in the transaction, and I like to specify the account category and then the account when I make my journal entries. And in this account description column, we'd also put a brief description of what that transaction represents. We then have a column each for debit and credit. So the debit side of the transaction is recorded in the debit column, and the credit in the credit column. And then the final column sometimes is called the folio column. I call it to GL, which basically means that after we do the transaction, we have to post this transaction to the general ledger. The general ledger is the book of last entry. So we do our transactions here, sort them out here, and then we post the debits to the appropriate accounts in the general ledger and the credits to the appropriate accounts in the general ledger. So let's go ahead and look at a couple of transactions. So on the 15th of January, you started the business, and the first thing you did was you put money into the bank checking account. That's your debit. You increased that asset. And where did it come from? Well, it came from the contributed capital that you and your partner put in, $500 each. So the equity account that was the source of the money is the credit, and the description is the seed money from partners. I should say partner A and B here, but that's fine. The next journal entry on the 17th of January, again, is a debit to the bank savings account, this time to the bank savings account. And what it represents is the loan from the bank, the $1,000 loan. And we've actually split the source of that loan into two credits. One is the current portion of the loan. That's the portion of the loan the bank expects you to pay back in the next year. And then that portion of the loan that will be paid back in over a year, and in this case it was $500 was each portion. Here is the deposit slip number for the savings account, as this represented the deposit slip number for the bank checking account. And this particular reference number just references the bank loan number that you have. So you're making it real clear where the money went and where it came from. The next transaction on the 25th of January, you went and bought some turntables, some speakers, and some vinyl records from your supplier. And so you created debits and an asset account, your equipment account called turntables, your speakers and vinyl of 800, 300, and 100. You also paid GST of $60. So that represents an asset. Why? Because you are going to be able to deduct that amount of GST that you paid from the GST that you owe when you start selling tickets and selling clothing. So it represents an asset that will be cleared out when you reconcile your GST payable to CRA. And where did the source of these assets come from? Well, it came out of your bank checking account, so that's what we credit. So here we have the supplier invoice number, and we have the check number that we paid for that, because we had to pay cash for the turntables, the speakers, and the vinyl. Let's go on to another transaction. At the end of the month, you went to a lawyer to draft your partnership agreement, and in this case, the asset that was decreased was your bank checking account, because the lawyer required cash, and this particular item is an expense, is a legal expense, and so that is what is debited. We talked before about why expenses are debits. And instead of calling it an equity, I'm using its subcategory of expense. So this particular T1222 represents the invoice that the lawyer gave you, which you paid on the spot, and this reference number 501 is the bank check that you wrote, and the description is paid lawyer to draft the partnership agreement. Moving on, the next day you paid your design company for the handbill work that they did on the designs, and so you started your asset account handbills inventory because you're just in the process of actually creating these things. So you debited that particular asset, and Design Inc. wanted payment right away, so you wrote them a check. Design Inc. doesn't have a GST number, so you weren't charged GST, so GST does not figure into this particular transaction. Then you took that design and you went over to the printer with it, and the printer printed the handbills for you. So again, the handbills the printing cost you $250, so that was debited to the handbill inventory account. The printer does have a GST number, so he charged you GST, so that GST that you paid becomes an asset, as I mentioned earlier, and you paid off the printer because again they wanted to get paid right away, so you wrote a check for $262.50, and here we have the invoice number that the printer gave you, and this is the check number. And then the one transaction that I'll look at in this video is once you handed out, this is an example of an internal transaction, once you handed out the handbills, then we created a handbills expense for the value of handbills you handed out. So you handed out 2/3 of your handbills by count, and so we have to expense 2/3 of the handbill inventory, and the handbill inventory, the balance in the handbill inventory is the $50 that you paid for the designing, and the $250 to the printer. So your handbill inventory had a balance of $300. You handed out 2/3 by physical count, so you have to expense $200. I'll go into these transactions in the next lesson because we do have time limits on these videos. But this should give you an idea of how we are using the general journal, and this is where the nitty-gritty of the bookkeeping aspects of your business are kept, and it's really important to keep a clear, neat journal that can be easily accessed by Revenue Canada and that has good reference numbers to source documents. I'll talk to you later.